And now we're going to talk a little bit about exchange traded funds. Before I get started, if you guys are listening and you want to give us a shout out, you're welcome to let us know you're listening. If you have any questions on any of these kinds of investments, you are welcome to ask me a question. I will answer to the best of my ability. Also, you are welcome to follow us on Facebook, Retire Rich and Happy, YouTube, Retire Rich and Happy, or retirerichandhappy.co.za if you want to get to our website and go and have a look at what we do as a company, how we help people to get on top of their finances, and how we help people to retire happy in 10 years. That is the goal. Okay, so the second part of flexible investments is exchange traded funds. So what is an exchange traded fund or an index fund? So what happened is, as I spoke about with unit trusts, the purpose or the goal for a fund manager on a unit trust is to try and outperform the benchmark of the market. So they're trying to beat the average. So they then did some research and they said, okay, but how often do these guys actually outperform the benchmark? How often do these fund managers that we pay millions and millions, how often do they outperform the benchmark? And they realized that more often than not, they don't outperform the benchmark. I can't remember the exact percentage, but it was something like 65 or 67% of the time. The fund managers don't outperform the benchmark. So they then said, but why don't we just become the benchmark? We become the market. So the fund then just tracks the average of that sector. And that's how exchange traded funds came into being, or index funds came into being. So it is not an actively managed fund, it is a passive investment. So what happens is the money goes into the market and it just tracks the average of that sector. So you become the average of the market, and through that you win more often than not. The benefit of an exchange traded fund is the fact that because there's no fund manager, there's no actively managed fund that needs to be paid, the fees for this is much less than the fund administration fees on unit trusts. So where you look at a unit trust maybe having a 1.5% cost on the fund, unit trust might only have a 0.15% cost. So it is much cheaper to run than a unit trust fund. So if you look at that, you might think to yourself, but then yes, why would anybody still invest in a unit trust? Because it outperforms the market more often than not, and it is much cheaper. Why would anybody decide to still go into a unit trust instead of an exchange traded fund? The problem with exchange traded funds is there's no protection for bubbles in the market. Because there's nobody watching this, it just becomes the average. So if there is one company, so let's say for example your fund is investing in the top 40 shares on the Johannesburg Stock Exchange in equal value. If one of the companies, like on our stock exchange, Naspers, overwhelms all the other companies from a size perspective, the fund will invest in Naspers in the same percentage that it is as part of the whole top 40 index, which then means that Naspers is so overvalued or overweighted in that fund of yours that if something happens to that one company, then your whole fund will fall flat and you'll lose a lot. Where an actively managed fund, the fund manager's job is to look at these things, see if it's going to be overexposed to certain companies, and limit your exposure to certain companies. One specific example of that is with Steinhoff in the retail sector. That was a very big company on our retail sector in South Africa, and then with the whole scandal that happened, Steinhoff shares just tanked. And if you were in an index fund, you might have been overexposed to Steinhoff, so So when it tanked, your whole fund would have gotten hurt. So that is one of the big risks with an exchange traded fund, is that you might be overexposed to specific companies in the market. There's definitely cost savings against actively managed fund. It is much, much cheaper than doing it in a unit trust. And what you must just be very careful of is to really look at what the effect is of expenses on your investment. People look at that and they think, oh, it's only 1%. But if you really do the calculation on what that 1% does, an extra percent cost on your investment over a 10 or a 15 or a 20-year period could be as much as a couple of 100,000 rand that it's going to cost you. Because not only is it what it's costing you for the investment, it is the compounding return on that that you're losing. So let's say you pay an extra 1%. If you didn't pay that 1%, you could have gotten a return on that extra 1%. And then the return on that extra 1%, that compounding effect over a 10, 15, 20-year period is massive. It is huge.